Well, good morning and welcome. My name is Teresa Campbell, and you have joined the PIM and PIA Mid-America Financial Executives Council program on tax law changes. Note that all of our attendees are placed in mute mode to ensure a quality recording, which we'll provide to all members. We encourage you to comment and ask questions during the program by using the Q&A and chat fields at the bottom of your screen. The Financial Executives Council is coordinated by leaders in both the North Central and South Central regions of the U.S. They guide the programs and content offered every other month through the year, focusing on financial reporting and compliance, data management, and security and financial policies and planning. Our council co-chairs are Carl Nathy with Myers Printing, Ryan Wagner with Action Mailing and Printing, Ken Rain with Daily Printing, and Matt Wills with LB Carlson. Matt, let's get started.
Thanks, Teresa. Today we have Jolene Pierce with us from LB Carlson. LB Carlson is a full-service CPA firm that provides assurance, tax, and advisory services to the graphic arts industries. As a tax partner in LB Carlson's Minneapolis office with over 20 years of experience, Jolene has assisted closely held businesses in various industries throughout complex areas of corporate tax compliance and tax planning, as well as represented on behalf of other clients before various taxing authorities. Welcome, Jolene.
Thank you. Thank you. All right. Hopefully I don't have any technical issues here, but we will get started. This is pretty heavy tax kind of changes that are potentially going to go through in the next year. And so let's just get down to the technical side of this. I'll go through my agenda here. Here's my disclaimer. This webinar, oh, sorry, I'm going to make this. There we go. This webinar is for informational purposes only. We do not warranty the accuracy of the information presented. We're not liable for losses or damages that may result from the information presented. You are responsible for any decisions made based on the information and opinions presented. And there will be several opinions towards the end as far as kind of where we think things are going to go and how quickly and kind of what direction. I have Matt Wills and Rob Younkers here to add in any information into the presentation. So let's get started here. Learning objectives today, we're going to go through, I think it's important going through the background of the Tax Cuts and Jobs Act. And really that's what we're going to be talking about. We're going to discuss the tax revisions sunsetting after 2025, and then provide some takeaways for an uncertain legislative environment. And the biggest thing with this presentation is to just plan. I'm going to suggest that you're going to plan to wait. You're going to plan to make some moves, and hopefully by July, mid-year, we're going to know the direction of how quickly things are going to go. But let's get started. Okay, so what I did here was I just took the kind of prior law prior to the Tax Cuts and Jobs Act, and then what it did. So some of these are reverting back. Let me just, will somebody tell me if there are questions or if anything pops up? Or will that come up into the side here?
We'll tell you, Jolene.
Okay, perfect. Thank you. All right, let's keep moving. So corporate tax rate, it went from prior law was marginal tax rate with a top rate of 35% down to a flat 21%. That is permanent. And the qualified business income deduction part of that was a new law as part of the Tax Cuts and Jobs Act. it now becomes a 20%, or it was a 20% deduction. And we'll go through these in more detail and later on in the slides. And we'll go through, especially with this one, we're going to talk about some planning as far as what we can be doing now. Entertainment, prior law, 50% deductible, and that was eliminated. This business interest expense limitation, 163J, business interest under prior law was generally deductible. Then it went to a business interest expense limited to interest income, kind of this calculation as far as getting that limitation. Significant impact for some taxpayers. Like-kind exchanges used to be where you'd turn in the equipment, do a like-kind, and we're able to forego that gain. And now with the Tax Cuts and Jobs Act, real property only. Next one, excess, and I'm only including the kind of the big ones here. Excess business losses. Before it only applied to excess farm losses. Now it's limited to 250,000 loss for single, 500 for married filing joint. Net operating losses. Before there was a carryback of 2 years, and now no carryback, but carried forward unlimited, but limited to 80% of taxable income. All right, and then bonus depreciation. That's a big one we use for planning. So bonus depreciation, prior law, it would have been 0, kind of phasing down to 0% in 2020. Tax Cuts and Jobs Act, 100% after that date, 9/27/17, and before 1/1/23. It decreased 20% thereafter, and includes used property. Section 179, that went from $500,000 deduction up to $1 million deduction, and now it's indexed for inflation. Luxury auto limits, minimal deduction prior law, and now more liberal deducting with the new law. Increased limits, no bonus, 10,000 first year, 16,000 second year. Cash method of accounting. Before it was 5 million or less, and you can elect cash basis. Now it's with the new law, 25 million. Opportunity zone. That was a new law where you could defer tax on reinvestment on qualified opportunity zones. And research and development, that was a new one. Now you have to amortize your expenses, your research and development expenses.
So Jolene, the only thing I'd add on the cash basis method of accounting is that's also indexed for inflation, right? So I think,
Oh, yeah.
I think currently it might be 29 million. I can't remember the exact number now, but that's, anyway. So for people that are flirting close to that line, it does get indexed for inflation.
Yeah, thank you. All right, so those were the major changes for businesses. Now let's move on to individuals. So tax rates are changing. Top rate prior was 39.6, went down to 37%. Excuse me, I'm working through this little bit of a cold here. Personal and dependent exemptions. Before they were 4150 indexed for inflation, and then that was repealed with the TCJA. Standard deduction, 65 single, 13 married filing joint. Those were essentially doubled, 12,000 single, 24,000 married filing joint. State and local tax. This has been getting a huge amount of press currently, as far as the state and local tax. Before it was generally deductible. It was capped at 10,000, and looking to increase that limit, and we'll talk about that a little bit later. Mortgage interest, 1.1 was prior law, 1 million of mortgage and 100,000 of line of credit, went to 750 $750,000. Medical expenses, 10% excess was prior law, 7.5 excess of adjusted gross with Tax Cuts and Jobs Act. And then the overall limit on itemized, there was a phase out before of 266, single 320, and that overall limitation was removed. Okay, let's go through a couple more for individuals. Child tax credit, that was in the press quite a bit too. 1,000 per child under 17, and phase out at 75 and 110, and then it went to 2,000 per child and 500 for other dependents, and then it was phased out at 200 single and 400 married filing joint. Another one, capital gains, qualified dividends. So before it was 0 rate if taxable income is below 25% bracket, and they went based on brackets. New law or Tax Cuts and Jobs Act, 0 rate if taxable income is below 38.6 single and 77,200 married filing joint, and then it goes up from there. AMT, this was a pretty significant change in the Tax Cuts and Jobs Act. The AMT exemption, we had a lot of taxpayers in that alternative minimum tax before, and Tax Cuts and Jobs Act raised the exemption 70,300 for single, 109,400 for married filing joint, and the phase out at AGI above 500 single and 1 million married filing joint indexed for inflation. Now that could be a pretty significant impact with these extenders. All right, then estate tax, the top rate, really we're looking at the estate or the amount of the estate. Before it was 5.6 single, 11.2 married filing joint, went to 11.2 single, 22.4 indexed for inflation. Lastly, I included the health insurance. There was a penalty for no health insurance, and now there's no penalty. All right, so we're going to move on, and again, this is technical. We're going to get in kind of the why the sunsets, why they have these, and maybe everybody knows about the reconciliation and the bird rule, but I thought it was it's pretty interesting as far as how these. Now that we have the majority, or the Republican Party has the majority, how this is going to kind of go through and get created. So why they have the sunsets, there's reconciliation in the bird rule. So the Tax Cuts and Jobs Act was passed under this process known as the reconciliation. It can't be filibustered in the Senate, and this is really a Senate rule, and then it can pass a simple majority. But there's certain rules that have to be followed. The bird rule says reconciliation must be budget related and cannot increase the deficit in years outside the 10-year budget window, and has a limit of 1.5 trillion in revenue costs inside the 10-year budget window. So this is what we're really focusing on as far as what is going to be extended, what is going to be how they're going to raise revenue, how they're going to or offset it with revenue. So it's going to be very interesting in the next year. One little tidbit, for the Tax Cuts and Jobs Act, it went through several revisions. So, I think we're in for quite a bit of press as far as, how and who is going to be happy with the changes. So what we're really looking at, so some of these provisions as part of the Tax Cuts and Jobs Act, they sunset after 2025. And so this year is really going to be crucial as far as planning for, because really, I guess in my opinion, everything, if everything is extended, the estimates are 4 trillion, I think it was, as far as an impact. So, there has to be some offset. So here are the provisions that we're looking at, that sunset after 2025, the qualified business income deduction, bonus depreciation, and some of these individual, the tax rate, standard deduction, itemized deduction, the child tax credit, personal exemptions, AMT, we'll go through that a little bit more. And then this big one, the estate and gift tax, the exemption there. So let's dive a little bit deeper into each one of these. And then if you have any questions, just let me know. All right, so qualified business income. So this deduction is a 20% deduction. So taxpayers who own businesses, partnerships, S corps, sole proprietorships, they can claim a 20% deduction on that income. Back when the TCJA was created, excuse me, C corps were down to a lower level, and this was kind of put in there in order to maybe equalize that deduction for the C corps, and so that the QBI was put in. Now the C corp rate is permanent. This is not, and so I think by maybe this could be something could be kind of, or this could be used as a revenue raiser. I'm not sure how, but it definitely could play into that. So just to kind of look through that, a tax impact of this, you have 500,000 of income from an S corp, 100,000 of deduction loss, 35,000 of additional tax. So, we're talking real dollars with the loss of this deduction or the sunset of this deduction. So we talked about, okay, what kind of planning, and I wanted to take this deduction separately and talk about potential ways we could plan, and we'll go through a lot of maybe options or strategies towards the end, but just to kind of keep these up or in mind, one option, if we know that this deduction could potentially sunset, we might want to accelerate income and defer deductions to 2026. It's going to be a huge impact for the tax situation if this is allowed to sunset. The other option, and I think this would be maybe an extreme case, but if it doesn't get, if it's allowed to sunset, you could potentially go from a S corp to a C corp. And we certainly, on the first round with the TCJA, we certainly had clients that did the switch from an S corp to the C corp because it made sense for their situation.
Yeah, just to dive a little bit deeper into that, I mean, what Jolene's talking about is just the spread in the tax rates, right? I mean, as she said, the C corporation is permanent. C corporation rate is permanent at 29%. And this qualified business income deduction is a deduction that you get on your individual return. And so it really turns the highest current individual rate from 37% to 29.6%. So there's about an 8.6% spread. Part of the difference between the S corp and the C corp also is the double taxation. So, when you factor in the double taxation and you look at the 8.6% spread, it wasn't common, but it did happen where some people converted from a C to an S. I think I maybe had one of my clients do that out of, 100, so not many. But now if this goes away, and this is probably, and I don't know if we're going to talk more about this later, Jolene, but this is probably why this is one of the provisions that we think probably will be extended. Because the difference now, if you're in the highest individual tax bracket in 2026, if these things sunset, you've got the C Corp rate still at 21%, the highest individual rate now at 39.6%. So now you've got a 19.6% spread. Well, you know, obviously you'll still want to do the math and look at the double taxation, but that's a much bigger spread and a lot bigger invite for people to convert from an S corporation to a C corporation. So, and I don't think, I mean, I guess not like I've spoke with a lot of congressmen and senators, but overall, I don't think they have a problem. I don't think they like small businesses to be C corporations. I think they like that S corporation option out there. So that's why, again, I think this is one of the provisions that they're going to figure out a way to keep in a new tax bill that will likely pass at some point. So.
Yep. And like I said, we'll get into some more of these. You know, we were talking yesterday, or throughout this kind of preparation, and sometimes if you have the option, if you don't mind extending your return just to give that additional amount of time to make decisions, wouldn't be a bad idea either. Even the 2024 tax return, I think we'll know a lot more by July of 2025 as far as the direction. So
that's pretty significant, almost 19+ %. That could be a big deal.
Yep. Mm-hmm.
Big deal.
Yeah. And, a lot of these things, it's not a quick decision. It's not a, I mean, we're talking in January, CPAs are going to be busy for the next couple of months. We're going to be, as far as doing stuff like that, but the day-to-day, but as far as planning can start right now in order to make those decisions easier later on. So,
yeah. And so Teresa, just to clarify a little bit, so the 21% C Corp is a flat rate. So on $1, you pay 21%. Well, the individual rates are progressive. So anybody who has an S Corp, they're going to fill up a 10% bucket, then a 12%, or guess I'm giving you the current rates, but they're going to fill up all of these buckets, and they're not going to get taxed at that 39.6% rate until they've got more than, if they're married filing joint, it's $650,000 or $700,000 of income. So that's another reason why you'd want to do the analysis. I mean, if you're a flow through entity, if you're an S corporation and you typically, the shareholder, and they don't have any other outside investments, they pull out a salary of $100,000 and that S corp makes $400,000. Well, they're not going to be subject to that 19.6% spread. It's going to be your higher income, higher earning corporations that are going to run into that big of a spread. Now, there still could be a spread because you're going to hit a 32 or a 35%, which is still a lot higher than 21 at a lower rate than that. And again, that's why before you do anything, you'd want to have your CPA help you go through an analysis and see if it does make sense. So, because it's not something, and I don't know if this question has come up, you can't just flip back and forth. I can't go, okay, I'm going to be an S Corp this year, a C Corp the next year. You change, you need to wait 5 years to, convert back. It isn't something you can just kind of each year decide you're going to flip back and forth on. So.
Okay.
Yeah. Great. All right. Let's move on. Bonus depreciation. I think this one could be pretty impactful, or is impactful for a lot of clients. So this one, I put, kind of just to see the applicable percentages, tax years starting 23 through 26, the allowable percentage scales down until the provision sunsets. So we're looking at 0% after 2025. Some of the things we've already talked about, the corporate tax rate is permanent, going from the marginal rate of 35% down to 21%. The other thing, those research and development costs That's been a pretty significant impact for some taxpayers as well. So those were made permanent. And then I wanted to just dive into or kind of show this a little bit different as far as the comparison of rates and the income in the separate brackets. So if you can, see the comparison, if TCJA continues, our rate, our highest is 37%, sunsets at 39.6. So the single income brackets, if it continues, our top, and I'm looking at the top brackets just for comparison, 642,000 versus at single brackets, and then TCJA, if it sunsets those brackets, so they're at income levels. Okay, going through some individual tax provisions, standard deduction. So if we look at the standard deduction, single went from 8,350, or will go to 8,350 from 15,450. Married filing joint 16,700 from 30,850, and then personal exemptions, those will be restored at 5,300. And some of these itemized deductions. So we talk about, or we've talked a lot about, we've heard in the press quite a bit, the state and local tax currently capped at 10,000. After 2025, it'd be fully deductible. And they're talking about raising that limit. I think the last press was about raising it from 10,000 to 20,000. Even at that, there was an impact of, Matt, do you recall the impact of,
billion.
What's that?
It's 22 billion over 10 years if they raise it $10,000.
Yeah. So just that small increase has a significant impact. And they're going to have to take into account all of this kind of back and forth in what gets extended and how they will raise the revenue in order to get those extenders through. Mortgage interest deduction suspended the home equity loan interest deduction and limited the interest deduction to the first 750 of debt. So it'll revert back in 26, back to that 100,000 home equity and the 1 million of mortgage interest. Charitable deductions, currently it's 60%, revert back to 50%. And then those miscellaneous itemized deductions will be coming back. The TCJA eliminated those. We had, especially individuals with mileage and all, they took their mileage through the itemized deductions. Those will be allowed starting in 2026. And the overall phase out of itemized deductions, 3% of AGI for higher income individuals, that will be coming back. Okay, so we're going to just the child tax credit that will probably, I think that'll get probably a lot of press. So it'll revert back to the 1,000. So you can see the phase out levels are pretty significant. So I think we'll see
I think you're right, Joe. So on that child credit, I would think that's another one that, I mean, I know the Republicans have control, but they may need to bargain on that one. That has held up the research and development expense being reversed the past couple of years. There's been a couple of bills introduced that would have allowed taxpayers to expense the R&D expenses, which I think both sides wanted, but there was always an addition in there to increase the child tax credit that the Democrats wanted and the Republicans didn't, and they couldn't come to any kind of accord on that, so the bill's always stalled. So that'll be another, you're exactly right, that'll be another kind of hot one, I would think.
Yeah. And so, going on to this EMT, it's kind of I mean, in some ways it's a guessing game. Okay, what's going to get a lot of press? What's not? I mean, with the alternative minimum tax, I think a lot of people, I don't know if it'll get a lot of press until people see the tax. If it doesn't get, if that doesn't get adjusted, or I think we'll see individuals feeling the hurt when they have to go pay taxes, or maybe at that time it would get high levels of press because of that. So it's pretty significant as far as the phase out level, the exemption phase out. So we're going from if TCJA continues or it gets extended for AMT, we're looking at a single 642,000. Compared to if we let it expire, it's back down to 157.7. Now that's it's indexed for inflation, but we're looking at just a significant spread in these exemption phase out. So married filing joint 1.285 compared to 210,000. So bottom line, if this doesn't get adjusted, extended, we're going to have a lot of individuals, taxpayers back in the EMT like we did before, pre-TCJA. So, or at least that's in my opinion.
Yeah, no, I mean, so I know we have people on here from probably lots of different states, but, we're based in Minnesota. And so we do mostly Minnesota tax returns. Minnesota is a pretty high tax state. And back before the TCJA, I would say, and maybe it wasn't 100%, but I'm going to say probably 100% of my individuals that earned between $300,000 and $600,000 or $700,000 were subject to AMT, and none of them are now. So yeah, this could be a big impact, and we don't want to turn everybody here into tax people, but basically, when we prepare an individual tax return, we figure out your tax liability on a regular tax and AMT basis. And lucky you and lucky all of us, we get to pay the higher of the two. So this could be a big deal, like Jolene said.
Yeah. As far as in the tax, I mean, not that I'm up at night, thinking about AMT, but I feel like I was, pre-TCJA because, and this one is it sneaks up on you. It can sneak up on individuals. Prior to this, we'd always look at, Rob talking about the state taxes. We would, if we could push out a state tax payment into the next year, we would do that in order to avoid some AMT. So I think I might be losing some sleep over this again, potentially, but okay, let's jump into maybe a significant thought on quite a few people's minds as far as, and maybe for me, I feel like this has gotten a little bit more press, the estate and gift taxation. So the exemption and potential sunset. So I just wanted to show this comparison of the estate tax and the exemption level, or the exclusion, I should say. 2023, 12.2, 24, 13.6, and 25, we're at 13.9. 26, we would be down to estimated 7 million per person. So it's a significant drop. This might come into play as far as the potential revenue raiser. Yeah, and then just taxpayers who die in 2025 with a taxable estate greater, just a tidbit about that. Some states have estate tax as well. So something to keep in mind. This one, the estate tax and, planning for that, we have been planning for the estate tax to sunset, as far as this intricate detail. We're always estate planning, but this sunset, we've been planning for quite a while for, and if things haven't been planned out, this is something that can't wait until the last month or the last, couple months. It's not a quick thing to do. So gifting, saying so. Okay. All right. So now we're through the kind of technical part of what I wanted to present and kind of the background of the TCJA, why this is such a kind of a big deal. And now we're just to the politics. So, I kind of feel sometimes we don't have a crystal ball, but I think no matter what happens, we can plan for it. But we also have to know, pretty quickly, decision-making abilities and things like that. So I just wanted to go through something that the politics side of it and look at the revenue raisers from these, from the potential, if, like we had said, the SALT cap and all that. So when I think of, and when I talk to a lot of people, the mentality is, hey, Republicans have the majority and they'll get it passed and we'll have no problems. And all the tax bills will be extended and we don't have anything to worry about. But really, when we talk about, do the Republicans really have the majority? There's such narrow margins. If we just compare, so in 17, with the passing of this TCJA, it was passed as that reconciliation bill, passed with 227 to 205, where 13 Republicans opposed. Now we have 219 Republicans to 215. So we've got a slim majority, or the Republican Party. They're the ones kind of heading up the tax bill. The Republican Party is. So there was a quote from Newt Gingrich, and it showed the history of what Trump needs to pass by July 4th. And I keep bringing up that July kind of the time frame, as far as we're going to know a lot by July, and they know this. So the history of this, Reagan failed to pass the tax bill by July 4th, and they lost 26 in the midterms. Trump failed to get something passed by July 4th and lost 40 seats. So Mr. Gingrich would like to see he called it, quote, one big beautiful bill, as far as getting it through. I don't know if, we're hearing in the press, one bill versus two bills. We don't know if it's going to be more successful with one big bill or split into two bills. Any opinions on that, Matt or Rob?
Yeah, I think the amount of bills matters, because as you can see, the Senate seats are only 53 for Republican, 47 for Democrats. So in order for the Senate to pass a bill on simple majority, they have to go through that Byrd rule, which limits that $1.5 trillion spending deficit over 10 years. And if it's one bill and they want to lump everything into one bill, that just means more spending cuts have to occur to pay for everything that they want. If it's two bills, obviously you can then use 1.5 trillion twice, so you can get more of what you want. The problem with two bills is it's never been done before in the history to pass two reconciliation bills in a year. So that's where they're kind of leaning towards one. But if we get one, the likelihood of it being everything the Republicans campaign for is probably slim, just because of the overall cost having to stay within that $1.5 trillion number, because the Senate only has 53 Republicans. Unless 7 Democrats jump on board to the bill, they have to pass it through reconciliation. I'm not a betting man, but I would probably bet that 7 Democrats don't do that.
Yeah. All right. So little bit more on politics, and we could probably spend all day talking about about what we think, potentially could happen, and if that happens, if this happens. But bottom line, Congress only has 149 legislative days in 2025. It's a lot to get done in a short period of time. And really, again, I go back to that July 4th, that's midway through the year. So from what we can tell, I think everybody knows the priorities are border security, energy policy, and tax cuts. So hopefully we see something within the next couple of months to give us a little bit more insight as far as where the tax policies are heading. So then I wanted to go through, and we mentioned a little bit about this. Extending all the TCJA provisions would cost $4 trillion. So there's that reconciliation that needs to be done between revenue and cost. So some other things that could potentially be changed or brought into the equation to get some revenue would be this carried interest changes, and I don't know how many it would affect here in this group, but there's somewhat of a slight loophole that it could change in order to pay for these extenders. The net investment tax could be adjusted to allow for that. Some excess business losses are set to expire in 2029, so those could be revised. And taxing large, the last three President-elect Trump had talked about potentially taxing large university endowments, lowering the corporate rate to potentially 15% for that made product, or for companies that made products in the US, and then of course the tariffs talk on imports. Then if anybody wants to read about a potential, I'm not confirming the validity, or not the validity, but there's potential spending reforms that could be brought into the equation too. So Politico had looked at some priority tax cuts on that.
Yeah, Jolene, and I think if we go back to that, just to kind of put a bow on this and wrap this all up, kind of preparing for this presentation, we kind of were under the same thought of, why do we need to start planning for 2026, the TCJA sunsets, and then we start looking at just the cost of expiring that tax package alone is $4 trillion over 10 years. Then if you start adding on to, no tax on tips, no tax on overtime, no tax on Social Security, bringing down the corporate tax rate, that cost gets increased even further based on all the campaign kind of pledges and promises the Republicans had. Now, obviously, there are some tax cuts, as far as spending cuts that are likely to happen, or taxing potentially endowments and all of that. But the realistic, at least my opinion, the realistic outlook probably is that not all of the TCJA is fully extended. Maybe some things get pared back, or the benefits don't necessarily materialize the same way as they did in 2017, just because of this cost number, and having to stick within, again, that reconciliation $1.5 trillion window. And and we're just talking about tax here. Now, if we lump border security, energy, all of that, like the Republicans want to do in one big, beautiful bill, now you can really start to see it is a good opportunity to start planning right now, because 1.5 trillion goes pretty fast when you've got a pretty large spending outlook. Not everything is going to get allocated to tax cuts, and some things are going to revert back to pre-2017 levels. So if we're not planning for it now, we could have a negative impact come 2026.
Yep. Yeah. Thanks, Matt. All right, let's go through some planning strategies, things that we're looking at for taxpayers and potentially doing within the next year. I mean, we're always looking at tax planning, but these would be some things as far as estate and gifting transfers. And these things, like I said, don't wait until December, because everybody's going to be busy in December. This would be something to get on the radar, especially with looking at starting the prep of potentially some tax returns for 24, and looking at doing some planning that way. So transfers, you could do transfers to family members, utilizing one spouse's lifetime exemption, making sure things are, working within a state attorney on things like that. The certain trusts that you could create, like I said, income tax planning strategies, reconsider some of the timing for deductions. And we go back to, we have seen retroactive, like I said in the prior screen or prior slide, there could be retroactive implementation of some of these things. So the more time you give yourself to plan, obviously the better it'll be, and not to wait until, even third quarter might be too late. So maximizing retirement contributions. Then some other ones, consider Roth conversions, utilize capital gains rate, especially if, or rethinking that business structure too, kind of going down the QBI deduction, education savings, harvest some of those capital losses, charitable giving, HSA contributions, especially if you have a pass-through entity. If we're looking at that 20% QBI sunsetting, that's going to, you're going to be paying a lower rate in 2025 compared to 26. So potentially structuring or reclassifying, not reclassifying, but looking at those deductions and potentially pushing some or pulling back some income. All right, and then some other strategies, like we said, back in the qualified business income slide, potentially accelerate income to 2025 and potentially 2024. If you extend your 2024 tax return and we get to August, July, August, and we know these things are coming through or the bill has passed, bill or bills, we could you could potentially accelerate some income into 24 and put that spread over the 2 years instead of just the 1 year of 2025, if that would make sense. If you could divert some deductions to 2026, especially taking into account those asset additions, if bonus goes away and bonus depreciation, you might have to depend more on the Section 179 if you're planning some equipment additions and equipment purchases. The other one, convert to an S corp to a C corp. That again, additional planning would be needed before any decisions to be made there. So, and again, extend your 2024-25 tax return. I know some people don't like extending that tax return, and there are cases where potentially you could extend your return, and if you need to get it filed, you do a superseded return, and you could go that avenue as well. So just an option to give you more time to make decisions and plan. All right, and there's my overall kind of lesson of this whole presentation is don't wait to plan, start planning right now, and be better prepared.
Yeah, I think it's not everybody's favorite thing probably isn't to talk to their tax person, I'm guessing, that's on this call, but start the discussions early, so that you guys everybody knows what page everybody's on, so you can make the best decisions. There could be some real significant dollars at play, potentially.
So are you
Absolutely.
suggesting they both delay filing or extend their taxes individually and for their companies?
Yeah, especially if you're looking at those pass-through entities. Yeah, it would be a suggestion in order to give more time and you know, in some situations it wouldn't apply. If none of these extenders, you know, if you aren't looking at or your pass-through entity, your S corp isn't really going to be affected by any of these extenders, obviously we want, you know, we wouldn't suggest you extend. But yeah, for the most part, I mean, I think that would be a good decision.
So kind of a real life example would be, let's just say somebody bought, or they have some pretty significant fixed asset additions in 2024. Well, if we think that tax rates are going to go up significantly in 2026, they may, you know, and they may not want to maximize those deductions in 2024. They may actually want to pay more tax in 24 and 25, saving those deductions for 26 and beyond when they're going to be in higher tax brackets. Obviously, they're going to want to consult with their own tax people to figure that out, but that would be kind of a real life example. I mean, if you think, we'll go back to that other example. If you think staying S corp's the right way and you're going to stay that way, well, the deductions in 24 and 25, if you're a high income taxpayer, are currently 29.6, assuming you're going to get that 20% deduction. They're going to go up to 39.6 if all of this sunsets. That's a 10% spread. So there's obviously a time value of money component as well, but that would be, you know, that'd be kind of a real life example where you might want to extend so you can do an analysis to see what happens. Well, and wait to see if the sunset occurs or not. If a couple of those items remain in play in 26 and beyond, then maybe if, you know, after, because a tax bill passes through reconciliation, then maybe you file your return then, but you may want to wait to see if you've got that kind of a fact pattern. There's other ones as well. That's just a kind of a real life example.
Sure, sure. You definitely have given us a lot to think about. I would say to those members who are on the call, you may think of questions that you have, and you can certainly send those through us or directly to LB Carlson to try and answer those questions. Certainly, there's some, you know, back and forth play of what's the best option for you and your company individually.
Yeah.
Yep, absolutely.
All right, there's a question here from Ryan. Are there any guides available for companies and individuals to take their tax advisors for questions to review? Any guides available to take to their tax person?
Guides available.
Like a resource? Is he looking for a specific?
They could take these slides. I mean, it would be, you know, an option.
I don't think there's any guides right now, and the reason there isn't is because during the campaign, during the Republican campaign for sure, there wasn't much of any actual substantial tax proposals, legislation, or anything that President-elect Trump offered compared to maybe what Kamala Harris did. So we don't really know, other than he wants to, you know, do the campaign pledges and extend TCJA. We don't really know what is actually he's proposing to change or not change. And that's kind of why we're doing the webinar, to maybe go start thinking about, all we know is that 1/1/26 currently, those tax rates or all those tax cuts revert back to 2016 levels. And it's going to cost a lot of money to extend them. So that's the kind of arena we're playing in. And that's what we want to communicate to everybody on the call, is really start being abreast to what's going on and planning now, because it does take some time, because there is not a lot of information out there. We're all guessing. And if you wait to guess and wait to see, you might be in too much of a late position to do anything substantial about it.
Yeah, and that's why the extend option was on there. I personally hate extending my clients' tax returns. I'd rather just get them done. But the reason to extend is because you're waiting for some certainty. Because yeah, I mean, if we file something on time, and we don't consult with our client on what might happen in the future, we're really just guessing what might happen, and we're guessing that what we're doing is the best decision.
And that could be significant, absolutely significant, in the short term and the long term, really. You know, if a group does nothing and stays in one corporation style versus one that changes from a C to an S corp, and then they're stuck with that for 5 years, that's not into their advantage.
Right.
Waiting to see is sometimes valuable.
Yeah.
And we do plan on having another webinar through the FEC on or when this tax legislation ultimately gets passed. I think everybody on the call is expecting something to happen. It just is a matter of when. So hopefully we can have that conversation and we can give more guidance on to maybe what planning strategies you can do after there's more certain legislation. But right now, kind of going back to it, the only thing that's certain is come 1/1/26, all of this stuff is reverting back, and it's anybody's guess what's going to happen before then.
Okay, well, great information. Definitely something we should be thinking about and watching from now until the first part of July to see what happens. Thank you. Thank you for the time that you took to put the slides together and present on all the different options that could impact. Really, the printing industry is primarily small businesses. And so everything you talked about really impacts them as individuals and as companies.
Yeah.
So thank you.
Absolutely. Yep.
We will pass along any questions that we get that need a professional accounting action. Maybe we go through you, Matt, and you kind of decide how you get it answered. But certainly anybody is welcome to contact anyone at PIA Mid-America or PIM to get those questions answered. Thank you. Have a great afternoon, everyone.
All right.
Thanks.
Thank you. Yep. Bye-bye.